Okay. Good afternoon, everyone. Welcome back to Byju's Exam Prep IAS. This is Sham Kagud here. Now, before we start the discussion, or let's say restart the discussion, if there is no issue with the sound, can you please give me a thumbs up so that I know that you are able to listen to me so that we can start the discussion. Okay, done. Let's start. So, what we have discussed, we are discussing the functions of RBI. Why taxation is there here? 1 second. Okay. Uh, we are discussing the functions of Reserve Bank of India. In the functions of Reserve Bank of India, first one we are done. It is the function of Reserve Bank of India to control inflation. In fact, if you remember, if you have revised it correctly, you will know inflation target given by the government is 4% CPI headline inflation. Then there is a function of RBI to print and distribute currency notes in India. Then the third one is RBI acts as a banker to the government of India. Okay. Now, before I go forward, before I discuss the concept of credit control, monetary policy tool, banker to the bank, etc., there are certain important concepts I want to discuss, and all of these are connected to each other. Before the break, we discussed something by the name of bond. Do you remember this? What do you mean by a bond? Bond is nothing but it's a debt instrument. Any problem here? Bond is nothing but it's a debt instrument. Debt instrument means what? Anything that is used to borrow from the market. The bonds can be issued by the companies issue bonds. Even the government, central government, state government is also allowed to issue bonds. And I told you specifically one term. In case of bonds, maturity period, remember that bonds will have a maturity period of more than 1 year. More than 1 year. Central government will issue different types of dated securities: 2 years, 3 years, 7 years, 10 years, maximum is 40 years. But remember the term here: state governments. State governments, the types of bonds that the state government issue, these are called as state development loans. These are referred to as state development loans. SDL, state development loans. Central government dated securities, state government state development loans. Okay. Now, we discussed one more concept, that is coupon. Do you remember the term coupon? Coupon in a layman term, layman means common man. Coupon in a common man, right, terminology, coupon simply means the rate of interest. Coupon simply means a rate of interest. Now, I'll discuss one concept. Understand this concept very carefully, because many of you get confused between the term coupon and the yield rate. Now, let me give you a very simple example. Let's start. Follow this very carefully. I will sell this bottle to you, and I'll say, right, whoever purchases the bottle will have to give me 100 rupees. Step 1. Okay, whoever purchases the bottle will have to give me 100 rupees. And I'll say after certain years, I will repurchase bottle. After certain number of years, I will repurchase the bottle again at 100 rupees. Which means I will pay the principal back and you will give me the bottle. But I will also tell you, whoever is owning the bottle, whoever has the ownership of the bottle, after 6 months, after 1 year like this, I will give the owner 6 rupees. Is the example okay so far? Let me know. Is the example okay? Step 1, I am saying I will sell the bottle to you. Okay. And I will collect 100 rupees from you. And for how many years? Let's say 5 years. After 5 years, I'll give you 100. I will take the bottle back. Point number 2. I'm saying after 6 months, whoever is owner of the bottle, whoever is holding the bottle, I will give them 6 rupees. After 6 more months, again, whoever is the owner of the bottle, I'll give them 6 rupees. And third very important point, third very important point, I'll say this bottle is a tradable. Understand the term now. I'll say this bottle is tradable. Tradable means what? If you want, you can sell this bottle to somebody else in the market. You can sell this bottle to your friend. Your friend can have the ownership of the bottle for 3 months, 8 months, 15 months as per the requirement. Then your friend can also sell this bottle in the market to somebody else. Now, please understand this carefully. After 6 months, or let's say after 1 year only, after 1 year, imagine you purchase this bottle. How much money I will give you? Think of it. After 12 months, you are the owner of the bottle. How much money I will give to you? Based on the number I've told, please reply to me. I will give you, let's say, annually 12 rupees. Let's say, right, rather than 6, confusing, etc. Let's say annual 12 rupees. Okay, annual 12. Somebody is saying 100 rupees. My dear, I said the bottle will be there with anybody in the market for 5 years. Listen to what I say. Listen to what I say. Right, after 5 years, I'll give you 100. But after 1 year, how much money I will give? If you are the owner, I'll give you 12 rupees. But what if after 6 months or after 3 months, you had sold this bottle to your friend? Now, after 1 year is over, can I say your friend is the owner of the bottle? All of you will agree? After this 1 year is over, you are not the owner. Your friend is the owner. So, who will get the 12 rupees? Your friend will get the 12 rupees. But look at the next point here. This is very important. Please tell me, what is the percentage of earning? What is the percentage of earning, right, that the owner will do if the person will earn a 12 rupee on investing 100 rupees? Calculate and tell me. It's a very simple number, by the way. It's not very difficult also. If the person will invest 100 rupee, get earning of 12 rupee, can I say percentage earning is 12% here? Anybody has a problem with CSAT? 12%. And I said, you can sell this bottle in the market. You can sell, you can purchase the bottle. Now, can I also say, when I say you can sell and purchase the bottle, market price of the bottle will keep on changing? Let me know. Market price of the bottle will keep on changing. If you ask me, sir, how the market price can change? What about supply and demand? Both the supply and demand, whenever the supply and demand changes, automatically the market price will change. If you don't agree with me, look at tomato prices. But on the other hand, what if you will sell this bottle to your friend at 90 rupees? You will sell this bottle to your friend at 90 rupees. After 1 year, I will say that your friend is the owner of the bottle. I will give the bottle owner 12 rupees. Now, please tell me how much is the percentage returns in the second example. Calculate. It's not very difficult number. 12 and 90. These are very, very simple numbers, by the way. Right, 12 and 90. How much is the percentage returns in the second example? Can I round it off? Around 13%. It will be more than that. I know that. It will be more than that. It will be more than 13%. Some of you are saying 11.2%. How is that possible? Apply CSAT. If the denominator goes down, how can the outcome be smaller, my dear? Apply CSAT knowledge, no? If the denominator goes down, the outcome has to be greater. That's the reason I simply throw a number. It will be more than 13%. Now, please understand, I'll make an inference here. If the market price goes down, tell me whether this is correct or not. If the market price goes down, the percentage earning done by the owner will go up. Correct or wrong? I'll repeat the statement. If the market price goes down, the percentage earning will increase. Let me give you third example. Rather than selling it 100 rupees, what if you will sell this to your friend at 120 rupees? Rather than selling it at 100 rupees, what if you sell it at 120? After 1 year, your friend is the owner. I will give, right, 12 rupees to the owner, right, owner of this bottle. Now, how much is the percentage earning done by the owner now? Percentage earning will be 10%. Right, it will be 10%. Now please tell me, can I say that if the market price of the bottle goes up, the percentage earning will go down? I repeat, if the market price of the bottle goes up, right, the percentage earning will go down. Now please understand, I will start replacing. The percentage earning that we are talking about, this is called as a yield rate. Percentage earning that we are talking about is called as yield rate. And based on this, can I simply say, whenever the market prices will change, yield rate will change in opposite direction? Is it okay? Right? Somebody is saying, sir, don't use bottle. Give me another example. I will come to that. Have patience. Always have patience. What I'm trying to tell you people is, when the market prices will change, the yield rate will change, but in opposite direction. Any problem with that? Can I write it like this? Market price is inversely proportional to the yield rate. Anybody has a problem with this formula? Market price is inversely proportional to the yield rate. That is, if the market price goes up, yield rate will go down, and if the market price will go down, yield rate will go up. And if you still have a doubt, please look at the examples that I've written. Do not by heart examples. UPSC is not going to ask you these calculations, but remember these. Remember this equation. This is very important. Now coming to the point. Rather than bottle, I'll replace this bottle with a government bond. Those of you who are asking, right, don't want bottle, give me another realistic example. Government bond. Government bonds can be bought and sold in the secondary market. Point number one. Anybody disagrees? I'll repeat the statement. Government bonds can be bought, can be sold in the secondary market. Yes or no? We have discussed all of this. I'm just putting it in a consolidation form. Point number two, just like the prices of tomato will change, can the prices, that is the market price of government bonds, also change? Think of it. Just like the market prices of tomato, onion will change, can the market price of government bond also change in the market? Of course, yes. How? Sir, how will the demand, how will the market prices change? What if all of you want to purchase bonds? Simple argument. All of you want to purchase government bonds. Don't you think the demand will go up? And if the demand goes up, what will happen to market prices? Market prices automatically will go up. And if everybody wants to sell, very few buyers, everybody wants to sell the bonds in the market, supply will go up, market prices will go down. This is very important. Please remember. Why? This is where people will get confused. Please tell me, coupon rate is paid on what? Think of it. Please go back. Right? A coupon rate is paid on what? Before the lunch, we have discussed all of it. Coupon rate is paid on the face value of the bond. Face value. Let's say there is a bond and the value of the bond is written by the government 100 rupees. Government has written on the bond 100 rupee. Government will sell it to you. Now, if you want to sell it in the market, don't you think you will be able to sell it at a higher than 100 or less than 100 rupee? Think of this also. Is it always equivalent to 100 market price? No. It could be more than 100. It could be less than 100 rupee also. For example, some of you are saying, no, sir, I will sell it at only more than 100 rupees. Not necessary. I'll prove it. Let me prove it. It's not necessary that you will always sell it at more than 100. You will end up selling it at more than 100 or less than 100 also. Right? Both the possibilities are there. How? Let's start. What if, think of it, what if there is a fear of recession in Indian economy? Look at the background. What if there is a fear of recession happening in the economy? Would you want to invest in any instrument or government bonds which are very, very safe? First one, think of it. Would you want to invest in Adani's company share? Would you want to invest in Paytm shares? Would you want to invest in anywhere, or would you want to invest in government bonds? Why I'm comparing government bonds here? Please tell me, between any instrument in the market and a government bond, which one do you think is more safer? Think of it and answer. Think like this, automatically you'll get the answer. Any instrument in the market against government of India bond, which is more safer? Government bonds will be very safer. Now, when the government bonds will offer so much safety, don't you think demand for the government bonds would automatically start increasing? Correct? Demand for government bonds automatically will start increasing. And when the demand will increase, what will happen to the market prices? Now, some of you will say, sir, every time recession will not happen. Does it mean only when recession is there, right? The demand for government bond will be higher? Not necessary. Imagine no recession, normal, no recession. Foreign investors will bring lot of money. Don't you think foreign investors would also be interested in government bonds? Does it make sense? Foreign investors, of course, government bonds are offering very high safety for them. They will also have a very good demand for the government bonds. So during normal times also, is it fair if I say the demand for government bonds might increase, which will increase the market prices of it? On the other side, stock market, that is the share market, does wonderfully well. Stock market is doing very, very well. Right? Other investments, you are able to get 9%, 10%, 12%. Would you want to hold all of your investment in government bonds then? Does it make sense to you? Right? Some of you will simply say, no, sir. I will take a higher risk in the stock market where the Sensex is reaching 66 points, 66K points, 67K points. So I know I will get better returns there. I will sell government bonds, take my money, invest in other market. Now, if a large number of investors will start doing that, what will happen to the supply of government bonds? Supply will increase. When supply increases, market prices automatically will go down. So understand the logic behind this. The market price of the bonds, because these are tradable in nature. Simple, these are tradable in nature. Market price of the bonds will keep on fluctuating. Sometimes it could be more than 100 rupees. Sometimes it could be less than 100 rupees. Some months it could fall down from 110 to 108 rupees. Or it could increase from 110 to 112 rupees also. Possibilities are there, and these will keep on happening because supply and demand forces are very much dynamic in nature. These are not constant. These are not same all the time. These are dynamic in nature. Now, please tell me, if you purchase a government security at 110 and you will sell this government security at 112 rupees to your friend, what will happen to the yield rate? What will happen to the yield rate in the market? Right? Don't you think the yield rate that is earned by your friend automatically will go down? All of you agree? Yield rate should go down. Right? And on the other side, if the market prices will go down, yield rate will start increasing. Any problem so far? This is a concept of yield. This is the concept of yield. Yield will keep on changing. Coupon is same, right? Because have a look at this picture. Again, I'm going back to the bond picture here. Have a look at this picture. When the bond is issued, isn't the coupon rate already decided? Look at it. Isn't the coupon rate already told to you? Is the face value already decided? Which means coupon is same. They will give you the same coupon. But at what price will you purchase the bond? Will you pay 90 rupees? Will you pay 95 rupees? Will you pay 105 rupees? That will determine whether your yield is going to go up or your yield is going to go down. This is the basic idea of yield rate, market prices, and coupon rate. And for the sake of examination, please remember this equation. Again, I'm saying for the sake of examination, please remember this equation. This equation is important. Questions have been asked based on this equation itself, and they will be asked again in the future. Now, why should you learn all of this? Right, have a look at this. Whatever I've discussed, I've given it in the picture. Nothing new. Please go through this. Why all of this is important? I'll prove it. There is a new tool used by RBI. Now they're not using this. Only during pandemic they used it. It's a new tool called as Operation Twist. Very, very famous, very interesting. Follow the sequence, automatically you'll understand. Very, very famous now. Now, before I start the discussion, is there any problem if I say 10-year government security is a benchmark? In the morning, I've told you this. Let me check again. Anybody has a problem if I say 10-year government security is a benchmark? Benchmark means what? It is a standard in the market. This is point number one. Any problem? If you do not trust me, I'll come back to this slide. Just give me a minute. Let me prove it to you. Please zoom in. Please zoom in and read this particular paragraph. Please zoom in and read this particular paragraph. What the paragraph says? SBI has raised the funds at 8.1%, 91 basis points higher than the yield on the 10-year benchmark G security. Did everybody read this paragraph? Please do let me know. I'll explain the paragraph now. Has everyone read the paragraph? Don't be lazy, right? Put in certain efforts. You will not get all of this in the books. What is the meaning of this? Right? Please understand. Government will issue different types of bonds in the market. Different types means different maturities. But there is one type of a bond which is considered to be a standard in the market, a benchmark in the market. And that standard or the benchmark is nothing but the 10-year government security. The 10-year government security. And what is the importance of this standard? Whenever the yield rate on 10-year government security goes up, overall interest rates in the market should also go up. I'll repeat the statement. Whenever the yield rate on 10-year government security goes up, overall interest rates in the market will also go up. Why? Many of you ask me, why, sir? Why? What is the meaning of yield rate? If you, right, let's say yield rate in this example provided is, right, let's say 8%. I'm just throwing an arbitrary number. Yield rate is 8%. Can I say if yield rate is 8%, it simply means whatever your investment is, whether your investment is 100, 50 rupees, 90 rupees, whatever your investment is, your returns is 8% on it. Can I go forward? Whatever your investment is, your returns on that investment is 8%. Now, have a look at this. On a government security, your returns is 8%. Imagine a company will come to you. They want to sell a bond to you. Will you purchase the company's bond if they are offering 7% coupon rate? Let me know. I'll repeat it again. The yield rate on 10-year government security, which is a benchmark, which is a standard, is 8%. Which means if you purchase a 10-year government security now, your returns will be 8% on your investment. I will come to you, I'm a company, I will come to you, I will offer a bond to you at 7%. Will you purchase this bond? You should say absolutely no. I will not purchase it. Why? The safest instrument in the market is giving me 8%. How can you offer 7% to me? Please keep it at least 8%. Yes or no? Does it make sense to you? Right? Yes or no? Now, what if I say market prices of government bonds will vary? Market prices of government bonds will keep on varying based on supply and demand. So, based on that, will the yield rate also keep on changing for government securities? Yes. And if the yield rate on government securities will keep on changing, can it make costlier for others to borrow or cheaper for others to borrow from the market? What do you mean by this? If yield rate is 8%, I can borrow from you at least 8%, right? I will have to offer you 8.1% or 8.3%, only then you will invest, purchase my bonds. What if the yield rate will go down to 6% now? Let me know. Last year it was 8%. Now this year yield rate will become 6%. Or 2 months ago it was 8%. Now it has fallen down to 6%. Does it happen? Of course, yes. Yield rates will keep on changing. Now, if the yield rate will come down to 6%, again, if I want to issue a bond, please tell me, will I issue bond at 8.3%? Think of it. Will a company issue the bond at 8.3%? It doesn't make any sense. If I'm going to issue and borrow from the market, can I issue at 6.2% now? Can I issue at 6.1%? Can I issue at 6.4%, which is a slightly greater, slightly bigger compared to government security? Because of course, government will give you more safety compared to me. So I will offer a slightly higher than this and borrow from you. Does it make sense to you? All I'm trying to convince you people, do not buy hard numbers. All I'm trying to convince you people is simple. 10-year government security is very important. Why? If the yield rate of 10-year government security will keep on changing, others in the market either will have to offer a higher rate of interest or a lower rate of interest to borrow from the market. Can I go forward now? So far, so good. Can I go forward? Any issue with this? Do not buy at numbers. Do not buy at calculations. Simple relations. Market price inversely related to yield rate. Market price for government bonds will keep on changing based on supply and demand. Hence, yield rate will also keep on changing. Now, I've introduced one more connection here. 10-year government security yield rate is very important because other borrowers in the market, right, basically will follow what is the yield rate on 10-year G security. Okay, that is the meaning here. Now, why all of this is important? Let me explain. There is this tool used by RBI called as Operation Twist. Now, in the Operation Twist, RBI purchases and sells government securities. Understand this. RBI purchases or sells government securities. And when RBI purchases and sells government securities, can I call it as an open market operation? Can I refer to this as open market operation? So suddenly in the UPSC, they will say Operation Twist is a type of open market operation. Don't get confused. RBI is buying and selling government securities. It has to be open market operation. But what is the speciality of this Operation Twist? What is the beauty of the Operation Twist? In Operation Twist, RBI simultaneously, that is very important, RBI simultaneously sells and purchases government securities. I'll go step by step. Follow this. RBI simultaneously sells and purchases government securities and same value of the same value. Meaning, RBI will sell 10,000 crore worth of government securities and simultaneously purchase 10,000 crore worth of government securities. Listen to the process carefully. Stop asking, listen to the process carefully. Many of you are typing, listen. RBI simultaneously sells and purchases same value of government securities. Many of you will feel this is an idiotic process. Doesn't make any sense. It will make perfect sense. What is the difference? RBI will sell 10,000 crore worth of short-term G securities, right? Maybe 2 years, 3 years, 5 years. And at the same point of time, will purchase 10,000 crore worth of 10-year government securities. So short-term G securities, sell. Long-term G security, that is a 10-year G security, purchase. Now, what is the impact? Why does RBI do this? It doesn't make any sense. I'll explain all of them. Step number one, RBI will purchase long-term G securities. Focus on long-term. RBI purchases long-term G securities. That is, right, 10-year government G securities. Okay, 10-year government G securities. Now, please tell me, if RBI will sell 10,000 crore worth of G security, simultaneously purchases 10,000 crore worth of G security, will there be change in money supply? Let me know. If RBI simultaneously sells a 10,000 crore worth of G security and purchases 10,000 crore worth of G security, is there going to be any change in the money supply? No, money supply does not change. Because on one side, I will increase money supply by 10,000 crore. On the other side, I will take out 10,000 crore rupees. So money supply does not change. And this is important, by the way. Why? If you want to promote growth, how does RBI do this? If RBI wants to promote growth, RBI has to increase money supply. Any problem with this? RBI has to increase money supply. But what if inflation rate is already high? What if inflation rate is already high? So when inflation rate is very high, RBI will increase money supply not to promote growth. Can it contribute to a higher inflation? Can it lead to higher inflationary trend in the market? There is a danger. Here, RBI is not changing money supply. So even if the inflation rate is high, no danger of causing inflation. Please remember this. Come to the second point. RBI will purchase a 10-year G security. What will happen to the demand for 10-year G security? Start now. You participate. What will happen to the demand for the 10-year G security? Demand will increase. And if the demand increases, what will happen to the market prices of these 10-year G security? Market price will also increase. And if the market prices will start increasing, what will happen to yield rate? Yield rate will fall down. And if the yield rate will fall down, right, can I simply say other borrowers in the market now can borrow at a lower rate of interest? Yes or no? If the yield rate will fall down, other borrowers in the market now can they borrow at lower rate of interest? Imagine earlier the yield rate was 7%. Now because of this, the 10-year G security yield rate will fall down to 6%. Right? Don't you think it will help the private sector to borrow at 6.2% rate of interest compared to 7%? 6.3% rate of interest? Of course, yes. So now private sector will be able to borrow from the market at lower rate of interest. And if they borrow and start spending money, investing money, it will help in promotion of recovery. Investment increases. Will it not help in promotion of recovery of the economy? Will it not create employment in the economy? Will it not create investment in the economy? All of this will happen because of Operation Twist. All of this will happen because of Operation Twist. Any problem here? But sir, lowering the interest rate may also cause inflation. Please understand this. We are not changing money supply. I hope you understand this. We are not changing money supply. Let's say in the bond market, now if I'm a company, until now my concern was yield rate on government security is 7%. Understand the logic behind it. Yield rate on government security is 7%. If I want to invest, I will have to borrow. But if I want to borrow, I will have to offer an interest rate or the coupon rate or more than 7%. But because the 10-year government security has fallen down to let's say 6%, can I borrow more amount of money from the market by issuing bonds at 6.1%, 6.2%, 6.3%? Of course, yes. We want the companies to borrow more. We are not making the loans cheaper for housing loan. We are trying to ensure that the companies will be able to borrow at a lower rate of interest so that they will invest, they will create employment, production will increase, and that will contribute to recovery in the economy. This is right the basic process of Operation Twist. This is how Operation Twist will work. And the beauty of this system is RBI without changing money supply. I repeat, RBI without changing money supply is ensuring that rate of interest in the market is going down. Because you can reduce the rate of interest by increasing money supply. But is RBI changing money supply under Operation Twist? No, it is not changing the money supply. It's keeping the money supply same, but with the utility of 10-year government security, it is suppressing, it is reducing the interest rates in the market. Done? Any problem? Can we go forward? Any issue with Operation Twist? Let me know. If there is no issue, I'll go forward now. Right, so these are certain important functions of RBI. The most important, another important function of RBI is monetary policy. Earlier we have discussed a fiscal policy. Now we'll discuss one more, monetary policy. Monetary policy, or else this is also referred to as credit control tool. This is also referred to as credit control tool or credit control policy. Now, how do you define monetary policy? Monetary policy is a set of instruments, set of policies which are available to Reserve Bank of India, using which RBI will regulate money supply. I will repeat the definition now again. Please understand. Follow. Credit control tools or monetary policy tools are set of tools, measures which are available for RBI, using which RBI will regulate money supply. Regulate means RBI will increase the money supply, decrease the money supply, or maintain the same amount of money supply in the economy. That is called as a regulation of money supply. And that is the precise reason it is called as a credit control tool. Now, these credit control tools are divided into two parts. One is called as a quantitative set of tools, which are also called as general methods. Second one is a qualitative set of tools, which are also referred to as specific methods or specific tools. Now, how do you define quantitative? Please look at the term quantitative. Quantitative set of tools. Using this, RBI will simply regulate money supply. You'll understand when I take up these tools. That is the next point, by the way. Okay, so quantitative set of tools. Example, CRR, SLR, repo rate, reverse repo rate, standing deposit facility, right? All these are quantitative set of tools. Why do we refer to them as a quantitative? Using this, the quantity of money overall in the economy will either increase or decrease. You can regulate only money supply. Whereas in case of qualitative set of tools, we will not only regulate money supply, we will also ensure the money will be created more, or let's say the credit will be created more or less in specific or targeted sectors. We can ensure that only in specific sectors money supply will increase or decrease. Can I go forward? Quantitative, overall money will increase or decrease. Qualitative, yes, money supply will increase or decrease, but we can target only one sector and change. We can target agriculture sector, change the money supply only in agriculture sector. That is the meaning of the term targeting. How you will understand in some time, have patience. When I take up PSL, it will become very, very clear to you. Now let's start. Quantitative set of tools, qualitative set of tools. Quantitative, first one, very, very famous now, repo and reverse repo. repo and reverse repo. Now, what is the repo and what is the reverse repo? Let's start with the basic definition. Repo, it is the rate of interest which is charged by RBI on the short-term loans that RBI will provide to the banks. Very simple. I'm giving you a textbook definition. I'll tell the meaning later. Understand the process carefully now. What is repo? Repo is the rate of interest on the short-term loan. Short-term means what? Generally up to 1 year. Generally up to 1 year. For example, RBI will give a loan for 7 days to a bank. RBI will give loan for 1 day to a bank. RBI will give loan for 14 days to a bank. So whenever loans are provided, RBI has to charge a rate of interest. So this rate of interest charged by RBI on a short-term loan, it is called as repo rate. And what is the reverse repo rate? What is the reverse repo rate? Reverse repo rate, it is the rate of interest charged by the banks when they will provide a short-term loans to the Reserve Bank of India. Have patience, listen first, then ask questions. Now let me start with the repo here. Look at the picture. I've given a very simplified picture here. Step 1, RBI will give loan. RBI will give loan to a bank. RBI will give a loan to the bank. And let's say amount of loan is 100 crore rupees. 100 crore rupees. Right? Within this itself, when RBI will give loan, don't you think RBI will ask for a security or a collateral from bank which is borrowing it? Please do let me know. Otherwise, if you want to understand it, imagine you go to a bank, you want to take a housing loan. Will the bank ask you for a security? Let me know. Will the bank ask you, please give me security? Give me certain asset, collateral, so that I can keep it. Based on that, I can give you loan. Right? So that is a concept of security or collateral. Now have a look at this. Bank, let's say, has 100 crore worth of government securities. Bank will deposit this with RBI. So on one side, bank will take 100 crore worth of loan and bank will provide a collateral worth of 100 crore G securities. Let's say after 7 days is over, either 1 day, 7 day, 14 days, whatever the number of days is over. Let's say after the tenure is over, Reserve Bank of India will return the security to the bank and the bank will pay 100 crore rupees plus right the interest to Reserve Bank of India. If the interest rate is 7%, is it okay? If the interest rate is 7%, the bank has to provide 100 crore rupee principal plus 7 crore rupee interest. If the interest rate is 10%, bank will give back 100 plus 10 crore rupee interest. If the interest rate is, let's say, 5%, the bank will return 100 crore plus 5 crore rupees. This is how repo will actually function. Any problem with the repo system here? Please do let me know. Any problem with the repo? Right now, let me enter into the technical argument here. Technicality. Most of the books have given only this. You understand the technical argument. What is repo? Repo simply stands for repurchasing order. Understand this carefully now. What is repo? Repo stands for repurchasing order. Repurchasing order. Now you will ask me, sir, what do you mean by repurchasing order? In a repurchasing order, one party will sell an asset to another party with the promise of repurchasing the asset at specific price on a specific date. I'll repeat it again. What is the repurchasing order? Repurchasing order simply means one party will sell one asset to another party with the promise of purchasing the asset back after specific number of days at a specific price. For example, have a look at this. Imagine here is a bank bank will sell asset worth 100 crore rupees, that is a government security, to RBI today. It will promise, right? It will promise that today I will sell 100 crore worth of G securities to you, right? And after 1 week is over, that is, let's say, next Sunday, after 1 week is over, the bank has promised to repurchase the government securities, that is the asset from RBI, at, right, 110 crore rupees. Can I call this as a repurchasing order? Think of it. Can I call this as a repurchasing order or not? Any problem with this? Please do let me know. Can I call this as a repurchasing order? One party sells asset to another party with the promise, that they will repurchase it on a specific date at a specific price. Now, based on this, can I say repo rate is 10%? Look at this. Based on this, right, repo rate, can I say it is 10%? This is how repo rate will actually function. Right? Although books will tell you this is how it happens, but in reality, what is repo? Why do we call it as a repo? This is the reason. Repo stands for repurchasing order. Bank is giving asset to RBI, taking money for it, but with the promise that after 1 day, after 7 days, after 14 days, they will repurchase it at a specific price. That is a repurchasing order. Can I go forward? Can I go forward to reverse repo? What is the benefit to RBI? My dear, in this case, don't you think interest rate earned by RBI is its benefit? Let me know. In this case, RBI is imposing and earning certain interest. That is, while, right, if you look at actual repurchasing order, RBI gave 100 crore, but it has got 110 crore rupees. Is it not a benefit to RBI? But more importantly, rather than looking at it through the lens of profit and loss, can RBI increase money supply in order to promote growth using repo rate? In fact, that is the most important tool now. If you're reading the newspaper on day-to-day basis, last month, right, there was a discussion regarding repo. Again, there will be a discussion regarding repo next week also, next month also. So based on the requirement, RBI will either increase repo or decrease repo. For example, tell me now, if RBI wants to control inflation, what do you think? Should RBI governor decrease the repo or increase the repo? If RBI wants to control inflation, should RBI increase the repo or decrease the repo? Think of it and tell me now. RBI should increase the repo. All of you will agree? RBI should. Some of you are saying decrease repo. Think again. Think carefully. RBI should decrease repo or increase repo? RBI should increase repo to control inflation. How? Let me prove it. You are a bank, right? You will get 100 crore rupees, but you will have to pay 10% rate of interest to RBI. If RBI will increase this 10% to 15%, which means to get the same 100 crore rupees, you'll have to pay 15 crore rupees to RBI. Will you borrow more? Think of it. Will you borrow more from RBI? No, you will borrow lesser. And when you will borrow lesser, what will happen to money supply? Money supply automatically will go down. Right? Does it make sense to you people? Please be very careful. Right? Once you understand, it becomes a game for you. But understanding the concept is important. What about reverse repo? Reverse repo is exactly opposite. Bank will keep deposits with RBI, and on these deposits, RBI will pay rate of interest to the bank. That is called as reverse repo. Again, this is a textbook definition. If you use this example exactly in opposite direction, right? That is, instead of bank, you write RBI, replace RBI with the bank. That becomes a reverse repo. So banks will keep deposits with RBI, and on this deposit, RBI will pay rate of interest to the bank. That is called as a reverse repo. Now, why will the banks do that? Simple argument. What if economy is right very risky? It is very risky to give loans to people in the market. People are losing jobs, right? Economy is expected to enter into recession. Already a lot of money is there in the market. You have taken a very high amount of risk by giving lot of loans. Now you tell me, if you're a bank manager looking at all of this situation, would you provide more and more loans to the market? You will simply say it is very risky, but you have lot of deposits. What will you do then? You will take these deposits, keep it with the Reserve Bank of India. Keep it with the Reserve Bank of India. And on these deposits, RBI will pay rate of interest to you. That is basically the concept of reverse repo. But please understand repo, right? Although it is reverse repo, repo is there. Repo means what? Same concept of G security is there. Now let me give you one situation. Let me give you one scenario. In reverse repo, imagine you'll go to RBI, keep 100 crore worth of G securities with RBI. I'm sorry, keep 100 crore rupee cash with RBI. And RBI has to provide you security or collateral. Agreed. Step one, by the way. Reverse repo, step one. You'll go to RBI and please answer me whether you're able to understand or not. You will go to RBI under reverse repo. You will keep 100 crore rupee with RBI. So RBI has to give you certain security or collateral, that is 100 crore worth of G security. Now what if RBI does not have sufficient G securities? Tell me, what if RBI doesn't have sufficient G securities? Then the whole concept of reverse repo will collapse. Then whole concept of reverse repo itself will collapse. How will the reverse repo rate work out? That is the reason now a new system has been introduced. This is not there in the books. Please update this. It is not there in the books. I know. Please update this. This is a new tool. A new tool has been introduced by RBI. Of course, Government of India has amended RBI Act and the new tool has been introduced. What is this new tool? The new tool is called as Standing Deposit Facility. SDF, Standing Deposit Facility. Now under reverse repo, what will happen? I'll write it this side. Please make a comparison and tell me whether both are same or different. I'll write it on the right side here. Reverse repo. Step 1. Step 1. Bank will keep cash with Reserve Bank of India, and Reserve Bank of India will provide G securities equivalent amount value of cash. The step 2, the bank will return the G securities to Reserve Bank of India and RBI will return the amount of cash plus interest to the bank. This is nothing but reverse repo. This is nothing but reverse repo. Please do let me know if there is any difficulty. Now make a comparison. On one side, I have written standing deposit facility, how it will work out. On the right side, I have written how reverse repo will work out. Please make a comparison and tell me, right, is there any difference or both are one and the same? Let me know. Is both one and the same or is there any difference? Can I say, right, on the face of it, if you look at it, automatically you will tell me, sir, in this, that is standing deposit facility, G securities are not provided. Some of you are saying same. Right, that's the reason. Please make an observation. Those who are saying both are one and the same, are G securities present under the system of standing deposit facility? At least now tell me, are the G securities, have I written G securities under standing deposit facility? Answer is no. If you don't trust me, look at the picture. I have not written G securities. Meaning what? Under standing deposit facility, RBI will not be providing any security or any collateral for the deposits that the banks will keep with RBI. It's very simple. Under standing deposit facility, right, the Reserve Bank of India will collect the deposits from the banks, right, for short duration, right, collect the deposit, will pay the rate of interest, but will not provide any security or any collateral to the banks keeping deposit with RBI. Any problem with this? Please do let me know. Any problem with this? And why this has been introduced? Argument is simple. Why this has been introduced? The concern was that under reverse repo, RBI has to provide government securities in the form of collateral. What if all the banks will take lot of money to RBI, keep it under, right? Let's say the reverse repo, RBI does not have sufficient G securities to provide collateral. Then reverse repo will become useless. Now, under the standing deposit facility, RBI doesn't have to provide any G security, no collateral will be provided, but rate of interest will be paid by Reserve Bank of India under the STF. Now, let me ask you the second question. Compare both the systems. Please tell me, if you're a bank manager, where do you think you are taking a higher risk? Let me know. Compare both of these systems. Are you taking a higher amount of a risk under STF or under the reverse repo? All of you will agree it is under STF. Somebody says yes to. How? Right? Somebody says the reverse repo. How under reverse repo you are taking more risk? My dear, you are giving 100 crore to RBI. You have a security of 100 crore from RBI. First example. Second example, you are giving 100 crore to RBI, but no security is given by RBI. So don't you think on the face of it, it is very simple? You are taking comparatively a higher risk under STF. If you are taking a higher risk under STF, what should be the rate of interest under STF? Below reverse repo rate or above reverse repo rate? Think of it. Apply common sense. Apply common sense. You will get all of this. Right? If you're taking a higher risk, if you do not collect any collateral, now will you accept the same rate of interest or lower rate of interest compared to reverse repo? No, it doesn't make any sense. You should demand a higher interest rate under STF. You can check it. SDF rate of interest is slightly higher compared to reverse repo. Remember this. Right? STF rate of interest is slightly higher compared to reverse repo. Generally, this is a sequence. This is repo. Below the repo, whatever is the rate of interest of repo, below repo, we will have standing deposit facility rate. And below standing deposit facility rate, you will have reverse repo. You will simply have reverse repo. Let me show it to you. Please have a look at the picture here. Please have a look at the picture here. Right? Can you make observations? Do not by heart. Can you make observations? Sir, what observation, right, you want me to make? Please observe what is a repo rate, what is a reverse repo rate, and what is a ESTF rate. There is one more rate, MSF. I'll come to that. Don't worry, I'll come to that. How much is the repo rate? How much is the reverse repo rate? And how much is the STF rate? And is it okay? Does it make sense to you? Repo rate is higher. Below repo rate, we have STF. And below STF, right? Below STF, right? Basically, we have reverse repo rate. Now, for most of the reasons, for most of the practical reasons, RBI doesn't conduct reverse repo. It basically conducts marginal standing facility. I hope you understand my point. For most of these times, RBI doesn't conduct reverse repo. RBI basically conducts SDF. Right, and that is the reason you will see that after April 2022, just observe this. After April 2022, and this, by the way, picture is from Economic Survey, you will see reverse repo rate is not mentioned. It has been discontinued. And we have introduced a standing deposit facility rate, SDF rate. Any difficulty? Is repo used in Indian market? Not very frequently. Most other times it is standing deposit facility. Right? If RBI wants to conduct reverse repo, it will conduct. But right, STF is the most important tool compared to reverse repo now. Sir, was STF in the current affairs? You type in the Google and tell me, was STF there in the newspapers or not? In the last 1 year, it is very often cited. What if RBI fails to return money or interest? You tell me any example where RBI has not returned the amount of money. My dear, RBI is not a commercial entity. RBI is not Kingfisher. so that they will invest and lose money and they will shut the company. No, RBI is a very, very well controlled, regulated institution. In fact, if you see, RBI keeps on earning thousands of crores of profits. So there is no instance where RBI has incurred a loss. RBI has always kept on earning profit. Okay, so when they are earning profit, there is no doubt they will repay all the money that, or all the deposits that they've collected from the banking sector. Can I go forward? Any issue? Let me know. Any issue? There is one more tool, MSF. I'll come to that. MSF stands for Marginal Standing Facility. I'll come to that. Now, please tell me, right? I'll use a term now. There is a term, liquidity in the banking sector. Liquidity in the banking sector. Earlier, liquidity was related to asset. Now, this is liquidity related to banking sector. Now, what do you mean by liquidity related to banking sector? Liquidity simply refers to the amount of money that is available. Money that is available, with the banks. Available with banks for lending purposes. Available with the banks for lending purposes. This is liquidity in the banking sector. Now, I'll tell you a statement. Please tell me whether this is correct or wrong. Using repo, reverse repo, and STF. I repeat, using repo, reverse repo, and STF, RBI can control liquidity in the banking sector. I'll repeat the statement. Let me know. Using repo, reverse repo, and STF, RBI can control liquidity in the banking sector. Now, why I'm discussing all of this? RBI will club all these tools under a system called as Liquidity Adjustment Facility. Liquidity Adjustment, LAF, Liquidity Adjustment Facility. And I hope you understand, based on the name itself, we can say what they are trying to do. This tool is called as LAF. Right? What are they trying to do under LAF? What is the objective of RBI to use LAF? RBI will use LAF to adjust liquidity in the banking sector. Please let me know whether does it make sense to you or not. If repo rate is increased, reverse repo rate is changed, STF is changed, automatically liquidity in the banking sector will also keep on changing. Done? Any problem here? Can I go forward? Next one is bank rate. Any problem? Can I go forward? If there is no issue, I'll go forward. Otherwise, please do let me know. We have discussed repo, reverse repo, operation twist after the lunch break. Next one is bank rate. Next one is the concept of bank rate. What is bank rate? Bank rate is the rate of interest charged by RBI on the loans given to commercial banks. What is bank rate? Bank rate is the rate of interest charged by RBI on the loans given to commercial banks. Now, before you start saying, sir, it is same as a repo, please look at the picture. Please look at the picture. Make an observation. Is this picture same as this picture? Please do let me know. Is this picture that is written for repo rate, is it the same as what is given for bank rate? Are both one and the same? No. That before you say yes, make an observation. Answer is no. Why? In repo rate, there is an agreement. Simple. There is an agreement. Asset is transferred. Asset is repurchased. There is an agreement. Whereas in case of bank rate, it simply means RBI will give a loan and keep on charging rate of interest on this particular loan. That is called as a bank rate. This is basically called as a bank rate. And please tell me, if you are a bank, think of it and do let me know. If you are a bank, if you are giving loan for let's say 5 years, 10 years, 8 years, will you charge a higher rate of interest or not compared to a loan where you are giving only for 7 days? Think of it. Right? You are a bank here, you will give loan for 7 days and you will give loan for let's say 2 years. You will give loan for 5 years, etc. Under what right situation? right? Is it example 1 or example 2? Where do you think you will charge a higher rate of interest? Will you charge a higher rate of interest where the loan is for shorter duration or where the loan is for longer duration? Economics dictates that you should charge a higher rate of interest here. Simple. You should charge a higher rate of interest here. Why? Risk is very high. Risk is very high. That's the reason. Now, based on this, can I simply say bank rate will be greater than repo rate? Tell me. Based on this, can I simply say bank rate should be greater than repo rate? Anybody has a problem in understanding the sequence? Right? Remember this. This sequence is important. Suddenly UPSC can ask you to arrange them. Right? Be very careful. Now, bank rate is greater than repo. Repo is greater than SDF. SDF is greater than reverse repo. Okay, this is the sequence. Please remember this. Right? This is a sequence. Right? So these are some of the tools. Now, apart from this, you also have a statutory liquidity ratio, and you also have one more, cash reserve ratio. Two more tools are there under quantitative. One is statutory liquid ratio, and the second one is cash reserve ratio. Both the statutory and, right, I'll start using short forms now. Both the statutory liquidity ratio and cash reserve ratio, both are referred to as reserve requirements. These are referred to as reserve requirements. And John Maynard Keynes, very well-known economist, right? John Maynard Keynes called these SLR as well as CRR as a variable ratios. Variable ratios or variable reserves. That is, you can vary these reserves, right? Accordingly, the banks will also adjust their reserves. Now, what is the importance of this? What is SLR? Why it is important? What is CRR? Why it is important? Let's try and understand. Let's start with SLR. To understand SLR, there is a term called as NDTL. Understand now. There is a term called as NDTL. What is NDTL? Net demand and time liabilities. Now you will ask me, sir, what do you mean by net demand and time liabilities? Let me explain this. Follow this example very carefully. Here is a bank. Bank will collect a deposit from the customer. Here is a customer. Bank will collect a deposit. The bank will have to return the deposit. Agreed? The deposit is collected and the deposit has to be returned back by the bank, has to be given back. Hence, for the bank, deposits are liabilities. Liability is nothing but a burden. Any difficulty in understanding the point number 1? Please do let me know. Bank will collect deposits from you, from me, from companies, etc. They will have to return the deposit. Hence, I'll call these deposits as liabilities. And on the other side, bank will provide loans to customers. Banks will provide loans to customers. The customers will repay loans along with the interest. Along with interest, customers will repay the loan to the bank. That is the reason the loans are considered to be assets for the bank. Loans are considered to be assets for the bank. Any difficulty in understanding why this is called as an asset, why this is called as a liability? Any difficulty, please do let me know. If nobody replies, automatically I'll understand that you have understood and I'll go forward. Right? Now, there is a term called as net demand and time liability. Net demand and time liability. Liability means what? Obviously deposit. Now deposits can be further divided into two types. Deposits can be further divided into two types. One type of deposit is called as a time deposit. Second one is called as a demand deposit. One type of a deposit is called as a time deposit. Another one is a demand deposit. Time deposit, best example, fixed deposit. Demand deposit, best example, right? Savings bank account, SBA, savings bank account. Now let me ask you a very simple question. Imagine you open a bank account, savings bank account, and you keep 1 lakh rupees in that bank account. Can I say you can withdraw this amount of money at any point of time? Think of it. Can I simply say that 1 lakh rupee that you have kept in your savings bank account, can you withdraw that 1 lakh rupees whenever you want to? Night is there, you can go to ATM, withdraw. You have gone to the market, you can use UPI and withdraw. Withdraw in the sense of transfer using UPI. So argument is simple. Whenever there is a demand for money, you can take out these deposits. Hence called as a demand deposit. But on the other hand, look at the time deposit, fixed deposit. You want 1 lakh rupee right now. You have 1 lakh rupee FD. Don't you think it will take some amount of time for you to withdraw that 1 lakh rupee FD? Anybody disagrees? Right? Compared to, let's say, a savings bank account, first you will have to close your FD. Then the amount would be transferred into your bank account. Then you are allowed to withdraw money. That is the reason this is called as a time deposit. Time deposit means for certain time, the amount will be there with the bank. Right? So one is a time deposit, one is a demand deposit. Get the sum total. Get the sum total of both of these deposits. It is called as gross demand and time liabilities. Demand and time liabilities. Gross demand and time liabilities. Now from the gross, right, DTL, NDTL, we need NDTL. From the gross, we will deduct interbank deposits. We'll simply subtract interbank deposit. What do you mean by interbank deposit? I'll give a very famous example. Payment banks, it's a compulsion. Payment banks will keep certain amount of deposit with a scheduled commercial bank. It is a interbank. Interbank means from one bank to another bank. Right? So minus interbank deposit, you will get NDTL, net demand and time liabilities. NDTL is this idea basically. I'll directly go to NDTL now. Have a look at this. Net demand and time liabilities. So what is SLR? Statutory liquidity ratio. Statutory liquidity ratio is a percentage. It refers to the percentage or proportion of NDTL that the banks will have to keep with themselves. I repeat, it is the percentage of NDTL that the banks will have to keep with themselves, either in the form of cash, in the form of gold, or in the form of approved securities. Best example is treasury bills, dated securities. You have state development loans. You have sovereign gold bonds. We'll go to sovereign gold bond later. Don't worry. In financial market, we'll have a detailed discussion on what is a sovereign gold bond. So I'll repeat it again. Statutory liquidity ratio refers to percentage of the deposits, percentage of NDTL, net demand and time liabilities, that the bank has to keep with itself, either in the form of cash, in the form of gold, or in the form of approved securities such as government securities. Now, think of this and please answer to me. Whatever the SDL is, if you are the bank manager, would you want to keep that money in the form of cash only, or you want to invest in gold, or you want to purchase government securities? What would you prefer if you are the bank manager? Let me know. Let me see how you people actually think. Would you want to invest that money in gold and purchase gold? Would you want to invest in G securities? Would you want to keep it in the form of cash? Gold is very risky investment. Those who are saying gold is a very, very risky investment. Please remember that. Gold is a very risky investment. Why? Do you think gold prices are always stable? Think of it. Do you think gold prices are always stable? No, very volatile. What if you purchase gold when the prices are very high? Now people want to withdraw money. You will sell these assets in the market. Gold price have crashed. You purchased at a higher price, sold it at a lower price. Don't you think that's a problem for a bank? So will you prefer gold? Preference is not for gold. Will you prefer to keep it in the form of cash? There is one more problem with that. If you keep it in the form of cash, imagine, I'll give a very simple example. Imagine the customer will come and keep a deposit of 100 rupees with you. And let's say SLR, hypothetical number, let's say SLR is 18%, which means out of this 100 rupees, you will have to take out 18 rupees, maintain it in the form of cash. But don't you think keeping it in the form of cash is also a problem here? Why? Do you think cash will get you interest? If you keep this 18 rupee in the form of a cash only, are you going to earn anything on this cash? Absolutely no. So what is the option available? Which is very safe, where right guaranteed returns are there, right? Which is the most preferable instrument for the banks to invest under the SLR, statutory liquid ratio? It is government securities. It is government securities, G securities. Please tell me whether this makes sense or not. Right? Can we go forward? This is basically SLR, statutory liquidity ratio. Next one is CRR, cash reserve ratio. Right? Cash reserve ratio. Now, what is this cash reserve ratio? You already have NDTL with you. I'll start using NDTL. It is the percentage of NDTL. CRR is the percentage of NDTL that the banks will have to keep with the Reserve Bank of India. Please understand the difference now. The bank will have to keep this percentage of the deposit with RBI, not with themselves, with RBI. Point number one. Point number two, whatever money you are keeping with RBI, RBI does not pay any interest on it. Point number two, whatever money you keep with RBI under CRR, RBI will not pay any interest on it. Point number three, right now the CRR limits are fixed between 3% to 15%. It is fixed between 3% to 15%. So RBI can bring it down up to 3%. It has already done during pandemic. It can increase up to 5%, increase up to 7%, increase up to 9%, up to 15%. RBI can adjust CRR. But right now, RBI has kept CRR at 4% of NDTL. This is the cash reserve ratio. So please now tell me, is there any issue with any of the instruments that we have discussed so far? Sir, not understood. My dear, if you collect a deposit of 100 crore rupees, you should take 4% of it, that is 4 crore rupees, and keep this 4 crore rupee with RBI. That's it. What is the difficulty in this? Please do let me know what is the difficulty. Take 4 crore rupee because CRR is 4% of NDTL, keep it with RBI. And RBI says any amount of money that you keep under CRR, I will not pay any interest on it. Right? And RBI has the power to fix a CRR in the range of 3% to 15%. Okay? Sir, in CRR, only cash is allowed or G security also? My dear, you will keep that in the form of cash with RBI. There is no option here. You will keep that 4 crore rupee cash with RBI. That's it. And there's a very interesting question. Full form of NDTL. Very bad. As far as I'm concerned, very, very bad. Why? Previous, right? 5 minutes ago, we have discussed it. In 5 minutes, you have forgotten what is the full form. Think of it. Right? In 5 minutes, you have forgotten what is the full form of NDTL. Okay. What is the need for CRR? My dear, RBI says, I will not allow banks to utilize all the deposits with itself. All the deposits which are there with RBI, I will not allow it to use it. Now the bank which has collected, let's say 100 crore rupees, RBI says part of it you don't use it. You cannot invest in G securities. You cannot invest in gold. You cannot give it in the form of loan. You simply bring it and keep it with me. That is RBI. Okay, done. Then what is the difference between SLR? You tell me what is the difference. You should be attentive now. Did I not say how SLR works out, how CRR works out? Then the question is, what is the difference? Right? Basically, you're trying to create questions now. Okay, done. Any other issues? Any other issues? Right. So this is a CRR, SLR, repo, reverse repo, STF, and there is one more, open market operation. Please don't forget that also. I've already discussed OMO. That's the reason I'm not discussing it separately. But OMO is part of quantitative set of tools. Right? Many of you ask me now, what is open market operation? It's already done, but anyways, open market operation basically refers to a system wherein RBI will sell or purchase G securities. Simple idea. That is called as open market operation. Now look at all these. Please look at all these tools. Tell me, is it okay if I say using any of these tools, overall money supply in the economy can be increased or decreased? Correct or wrong? I'll repeat the statement. Using any of these tools, that is what we have discussed until now, quantitative. Using any of these tools, I'll be able to either increase or decrease or maintain the money supply in the overall economy. Now look at any one of them and please let me know, can you increase money supply only in agriculture sector? I'm talking about quantitative, by the way. Quantitative. Look at any one of them. Can you target and increase the money supply only in the agriculture sector? Any tool that is available to you here? No, it is not available. Can you target what is interest rate on only housing loans using these tools? Not possible. Why? Overall money supply in the economy will increase or decrease, right? It cannot be used to target only one sector or specific sector like this. That is the reason there is one more set of tool called as qualitative set of tools. Qualitative set of tools. Now, before I look at or start discussing qualitative set of tools, if you have any doubts, please do let me know. Right? Please do let me know. Otherwise, we'll go to the next part of the discussion. What is the range of CRR? 3% to 15%. That is what has been decided. But security bonds also subject to market demand and supply. It can disturb a SLR amount or not. Yes, sir. How? What is the context you're asking? But security bonds uh, also subject to market demand and supply. It can disturb SLR. I'm not able to understand the question. Frankly speaking, I'm not able to understand. Please rephrase. Please rephrase and tell me, right, so that I can answer to your question. Anything else? Any other doubt that you people have? I've activated live call feature also. Please do let me know if you have any questions. Anybody has a doubt? Nobody is asking anything. Sir, we are experts now. Ask us anything in the banking sector, we'll answer it. Huh? Arey Baba, publicity, I have not yet gone to qualitative. Please wait. I have not gone to this side of the table. I have finished only this side. Only the left side, not the right side. What is SLR? SLR simply means a statutory liquidity ratio. The percentage of NDTL that the bank has collected, the bank has to keep it with itself in the form of cash, in the form of gold, or in the form of G security. Imagine SLR is, right, let's say 15%. Imagine SLR is 15%. It simply means if you collect deposits worth 100 crore rupees, 15% of the deposit you'll have to keep with yourself. That is SLR. Jogendra, please receive the call. Cash reserve ratio, same. Percentage of NDTL you'll have to keep with RBI. That some of you are asking questions which are straightforward, very straightforward. You collect 100 crore rupees. If CRR is 10%, take 10 crore rupees because 10% of 100 crore is, right, obviously 10 crore rupees. So 10 crore rupees, you take it, give it to RBI. That is cash reserve ratio. Vishal, please receive the call. Interbank deposit. Interbank deposit means one bank will keep deposits with another bank. Banks do this. Trust me, I'll show it later. One bank will keep deposit with another bank, hence called as interbank deposit. So when you basically calculate NDTL from the gross, that is the total deposit, you'll have to subtract interbank deposit. I'm giving a call, but nobody is replying. Those who are saying, "Sir, I've given a call, I gave the call back," but there is no reply from the other side. Is monetary policy and fiscal policy one and same? No, my dear. Monetary policy is framed by Reserve Bank of India. It is made by Reserve Bank of India, whereas the fiscal policy is done by Government of India. Fiscal policy talks about taxation, talks about expenditure. Monetary policy talks about only money supply in the economy. Right? Both are different. Okay. So let me go forward then. Let me go forward. Okay. So monetary policy tools. Let me go to the other side. Qualitative set of tools. Qualitative set of tools. Sir, you have written second diagram in CRR. There is no diagram which I have not explained. Maybe I have not written it, but explanation is done for all the pictures. Please look at the second picture. Second picture in CRR. Did I not discuss what is an asset, what is a liability for the bank or not? Tell me. Did I not discuss what is an asset, what is a liability for the bank? So where have you discussed? Don't lie, my dear. Here. What is this? What is this? Please tell me. Is it not one and the same? Both are one and the same. Right? Again, please understand. I know the classes are very lengthy. Economics is technical, but you'll have to be attentive in the class. Please be attentive in the class. Right? I don't write anything and I don't leave anything that I've written in the slide without explaining. If I do that, please raise it. I'll explain it. Okay, done. So the quantitative is over. Let me enter into qualitative set of tools. Qualitative, by the way. What is a qualitative? First one, the rationing of credit. The first tool is a rationing of credit. Now, what do you mean by rationing? Rationing simply means distribution. All of you agree? Rationing refers to what? Rationing simply refers to distribution. Distribution. Now, if I say distribution of the credit, what does it mean? Under rationing of credit, we are trying to ensure how credit will be issued, how loans will be issued by the banking sector to various sectors or the borrowers in the market. Why this has to be done? Let me ask a very simple question. How many of you, if you become the bank managers, talk like a bank manager. Don't talk like an right economist or let's say right an Indian. Talk like a bank manager. How many of you, when you become a bank manager, if a farmer will come to you, wants to take a loan for cultivation of any agriculture crop whose prices have crashed now, you will give loans to the farmer? Let me know. How many of you will decide, yes, sir, farmer, backbone of Indian economy, right? I will give loan. Tomato prices, let's say after 2 months, will crash. Right? Don't you think you will be concerned about giving loans? Again, I'm not saying they are wrong. Please understand, I'm not saying they're wrong. They are also supposed to take care of their customers, that is depositors. They are using depositors' money. They are not using their own money. They are using depositors' money. What if there is a recession in the global market and an exporter will come to you, ask for a loan? Don't you think you'll be concerned about giving loan to an exporter? I hope you understand. So argument is simple here. If given a choice, banks would prefer giving either very less amount of loan or no loans at all to some of the sectors in the economy. I'll give you a third example. Education loans. Tell me, education loans. If you are a manager, would you prefer giving more and more education loans or loans to industries? Right? So I hope you understand the argument that I'm trying to make here. So there are certain sectors where giving loan is very risky, very risky. So given a choice, banks would not prefer to give loans to these industries. Now what should the government do? What should RBI do? Should they keep quiet? No. There's a tool used by RBI, rationing of credit. Under rationing of credit, that is a distribution of the credit, RBI has introduced a tool by the name of Priority Sector Lending, PSL. Priority Sector Lending, PSL loans. Very famous, PSL, Priority Sector Lending. And what does the Priority Sector Lending mean? RBI says 40% of the credit issued, 40% of the loans that you actually issue should go to following sectors: agriculture, export, education, right, housing, startups, etc., etc. So there are various sectors. There are various sectors which are covered under the PSL, and banks will have to ensure that 40% of the loans that they provide annually, 40% of the loans that they provide annually should be going to these sectors only. There's a term MSME. MSME stands for micro, small, medium enterprises. We'll discuss MSME later. Have patience. Right. So government ensures, RBI through the policy of priority sector lending ensures that there is a appropriate, not equal, appropriate rationing of the credit. Now there is one more term here. Most of the books will simply tell you 40% of credit, but it is not directly credit. It is called as adjusted net bank credit. 40% of adjusted net bank credit. Now, what do you mean by 40% of adjusted net bank credit? ANBC simply stands for, it is the net bank credit plus investments made by the banks in the non-SLR bonds. Non-SLR bonds. That is, the banks will invest in other bonds as well, apart from bonds under SL category. All of you agree? Banks will invest in other types of bonds in the market, not just government bonds. Other types of bonds banks will invest. These are called as non-SLR bonds. Non-SLR bonds. So what is ANBC here? Imagine a bank is giving a credit of 100 crore rupees and they've invested 10 crore rupees in the non-SLR category bond, then I'll count it as 110 crore rupees. Adjusted net bank credit will become 110 crore rupees. I will have to count it as 40% of 110 crore rupees. This is how ANBC is calculated. Again, this is a technical calculation. Don't buy heart. UPSC is not going to ask you this calculation. So this is a rationing of credit. Now please tell me, can we use a rationing of credit to specifically target one or two sectors in the economy? Think of this and answer. Can we use a rationing of the credit to target, let's say, MSME sector? Can we use a rationing of credit, that is a PSL, right, a tool, to target agriculture sector? To target, right, let's say, education loans, etc.? Possible? Yes. That is the reason, right, this is a type of qualitative set of tool. Tell me now, does it make does it make it easier for you to understand why it is qualitative, why those are quantitative? If you remember, this is what I'm trying to convey to you people. To begin with, I said there are two sets of tools, quantitative and qualitative. In quantitative, only money will be regulated, increase or decrease. But in qualitative, we will regulate, but we can target specific sectors. Right? We can target specific sectors. That can be done within qualitative. Okay, so this is important. Please be very, very careful. So first one is the rationing of credit. 40% is overall for all these around 8 areas, right? Weaker sections of society, right? We have startups, we have educational loans, export credit, affordable housing, agriculture, MSME, renewable energy, etc. Eight sectors are covered under this argument of rationing of credit. And out of this, out of all of these eight, highest weightage has been given to agriculture. Please remember that. Out of all of these eight, highest weightage, highest amount of loans are always given to agriculture sector because RBI says so. Right, around 18%, around 18%, right? That is a number. That's a number that is decided by RBI. Right, this much amount of loans, 18% of A and BC should go to agriculture sector. Right, this is a concept of priority sector lending. Next one is the regulation of consumer credit. Regulation of consumer credit. Now, what do you mean by regulation of consumer credit? Under this, RBI may force the banks to change EMI and reduce the number of installments. EMI stands for equated monthly installments. Equated monthly installments, EMI. Now, what is this concept? Why RBI will use this, etc.? Let me explain this. And imagine you want to take a housing loan. Okay, imagine you want to take a housing loan, or let's say car loan. Take car loan. Car loan is easier to explain. Imagine you want to take a car loan. Now the bank is offering you. The bank is offering you a loan facility wherein you can repay the loan in, let's say, 7 years. Where you can repay the loan in 7 years. Now, when you take a loan, monthly you'll have to make certain amount of payment. All of you know this. When you take a loan, either housing loan, personal loan, right, agriculture loan, or whatever it is, right, if you meet the conditions, on month to month basis, you'll have to make certain amount of payment, which is called as EMI, equated monthly installment. Now, why this is important? Let me explain. What if RBI will ask the bank not to provide loans for 7 years, reduce the tenure of the loans to 5 years? Please tell me now. What if RBI will tell the bank, don't provide loans for the tenure of 7 years, provide the loan for 5 years? Please think of it and tell me, if you take a car loan, compared to 7 years, now you will have to repay the loan in 5 years. What will happen to the monthly payment that you will do to the bank? Will the EMI increase or decrease? Will the EMI go up or go down? All of you will agree EMI has to go up. Is there anyone who says, no, sir, no, EMI should go down? No, my dear. Shorter duration means what? You'll have to repay the loan within shorter duration. EMI will go up. Now, if the EMI goes up, please tell me, will the number of loans taken, loans given, will those numbers go up or go down? Automatically, the loans issued should also start going down now. And if the loans will go down, what will happen to the demand for cars? What will happen to the demand for housing units? What will happen to the demand for, let's say, laptops, etc.? The demand will also start going down. So now, please tell me whether this is correct or not. RBI can use this tool if there is a very high demand in the car segment. And this car segment demand is threatening. It's a danger to the overall inflation system in India. So can RBI do this? Can RBI use this tool to control only the loans issued in the car segment, that is car loans? Can they use it to control the loans issued to the housing segment, etc.? Right? Regulation of consumer credit. So consumption credit in a specific sector can be regulated, can be either increased or decreased. It can be increased as well. For example, rather than 7 years, now what if RBI tells the banks, don't give it for 7 years, give the option even for 10 years. If the borrowers want, they can repay the loan even in 10 years. Give that option. If it is increased from 7 years to 10 years, automatically EMI component will go down. If the EMI component will go down, demand for such loans will increase in the market. That will promote recovery, higher demand in the market. So based on the requirement, RBI can tweak the policy and ensure demand will go up or go down, right, based on the requirement. Third one, variation of margin requirement. Variation of margin requirement. Now, what do you mean by margin here? Let me explain. Imagine you want to take a housing loan. Those who have a housing loan, they will easily understand this. Those who do not have a housing loan, please ask your parents. Right? Those parents who are repaying the loan, they will tell you the pain of it. You want to take a housing loan. The value of the house is, let's say, 1 crore rupees. You want to purchase a house, and the value is 1 crore rupees. Now, please tell me, how many of you think bank will give you a loan of 1 crore rupees? Let me know. How many of you believe that a bank will give you a loan of 1 crore rupees equivalent to value of the asset? No, bank will never do that. Trust me, bank will never do that. Why? What if you don't repay and the housing market in that duration has fallen down? So bank will never, right, give you the value of 1 crore in the form of loan. Let's say they'll say, right, 80% value of the house. 80% value of the house is the maximum amount of loan we will give you, which means housing value, the house value is 1 crore. The value of loan you will get is 80 lakh rupees. And this is important. Why? Look at the next point. You take a housing loan, what will you do? Will you keep the house documents, right? The house documents itself as collateral with the bank? Yes or no? Will you not keep the house documents as a security with the bank? Which means 1 crore worth of collateral is there with the bank, and the bank is telling you 80% of, right, the asset, 80% of the collateral I will give you in the form of loan. And the same thing will happen even in case of gold. If you don't trust me, please ask someone who has taken a gold loan. If the market price of gold is, let's say, 5,000 rupees per gram, if you pledge gold, bank will never give you 5,000 rupee loan. They'll give you 80%, 90%, 95%. They are allowed to go up to 100% now. But banks generally keep a margin. What do you mean by margin here? Value of the collateral is 1 crore. Value of the loan that you take is 80 lakh. The difference between this is called as margin. Any difficulty? The difference between the value of the asset and that is value of the collateral and the loan value, it is called as margin. 20 lakh rupees margin. Any problem? Any problem? Can I go forward? What about gold loan? What about gold loan? You will have to pledge the gold. Up to certain percentage of the gold value, they will give you loan. That's a basic idea of a gold loan. Now, what if I say margin is decreased? Think of it. What if I say margin is decreased? And there is one more important point I just forgot to tell you. If a value of the house that you want to purchase is 1 crore, bank is willing to give you 80 lakh rupees, who will put the remaining 20 lakh rupees? Tell me, who is going to put that extra 20 lakh rupees? The buyer. From the pocket, they have to put 20 lakh rupees. All of you will agree? Now look at the next point. What if margin is increased? What if margin is increased from 20 lakh rupees to, let's say, 40 lakh rupees? Which means if the value of the house is 1 crore, bank will give you a maximum of 60 lakh rupees in the form of loan. Which means from your pocket, you'll have to put 40 lakh rupees. Now tell me, when the margin is increased, people will take more loans or less loans? Let me know. If the margin is increased, will the people take more loans or lesser loans? People will end up taking lesser loans because compared to earlier situation, now I'll have to put 40 lakh rupees, right, for purchase. Or those who are saying more, please revalue. If the margin is increased from 20 lakh to 40 lakh, what does it mean? You'll have to invest 40 lakh rupees from your pocket. Do you think people will have more money to spend on an asset like this? No, people will be worried. They'll simply say, I cannot spend 40 lakh. So the demand for such loans will go down. What if the margin will go down? From 20 lakh rupees, margin is made 5 lakh rupees. Think of it. From 20 lakh rupees, margin will be made 5 lakh rupees. Which means The bank will give you loan up to 95 lakh rupees now. And only 5 lakh rupees you'll have to put from your pocket. Don't you think more people will take loans now? So this is how margin requirements are changed. Margin requirements are changed by RBI through banking sector, either to increase or decrease the demand for certain type of loan in the market. Shall we go to the next one? Shall we go to the next one here? Right. So first one is priority sector lending. Second one is variation of margin requirement. Third one is variation of consumption credit. What is the observation you need to make? These three are very important. Observation is simple. RBI is using these tools to target specific sectors, not overall economy. Target specific sectors. That is important. Now let me go to the last one, publicity. I'll come back to direct action and moral suasion. Don't worry. Let me go to the last one, publicity. Now let me show a picture to you. At Big B, let me show a picture to you. Don't by heart the picture. UPSC is not going to ask the picture to you. Just make an observation in the picture and tell me both of these are the advertisements given by Reserve Bank of India. What is RBI trying to do by giving these advertisements? Let me know. Do not by heart the pictures. UPSC will never ask you these pictures. When you read these ads, what are you trying to understand? What is the information that you are getting? Can I simply say, first one, right? In the first one, you need to scan QR code for sending money, not receiving it. Right? Basically, isn't RBI trying to impart knowledge, provide knowledge to the banking customers? For example, how many times have you seen this? People who are not digitally literate are cheated. How they are cheated? Somebody will say, I've sent a QR code to you. Please scan the QR code and you will receive the payment. Have you come across scams like this? Frauds being done on people based on this only. They'll send a QR code and they'll say, scan, your account will get money. People are not so much literate. They are not digitally tech savvy. They will listen to them, they'll scan the QR code without realizing QR codes are to be scanned for making payment, not receiving payment. They will end up, right, being cheated with their money. By using this advertisement, what is RBI telling you? RBI is imparting knowledge. RBI is educating the customers. This is publicity. I hope you understand. Right? This is nothing but publicity. Have you seen various advertisements even in TV? KL Rahul, cricketer KL Rahul will come and say, RBI कहता है, right? जानकार रहिए, सतर्क रहिए, whatever it is. Right? Or some other bowler will come and say, RBI कहता है, जानकार रहिए, सतर्क रहिए. Big B will come and say, RBI कहता है, जानकार रहिए, सतर्क रहिए. What are they trying to do? They are trying to educate customers. This is called as publicity. Nothing but this is called as publicity. Done? Right? So what is publicity? It is basically to create a public opinion, to educate people, to create awareness amongst banking customers as to what they're supposed to do, what they're not supposed to do, etc. etc. That is publicity. Moral suasion. Moral suasion basically is a policy tool. It's not related to credit control specifically, it's a policy tool. What RBI says is, RBI has various guidelines. The banks are supposed to follow all of these guidelines. If the banks do not follow the guidelines, RBI under moral suasion will try to persuade the banks. Will try to make them agree, make them follow the guidelines. Now, how will RBI try to persuade under moral suasion? They will send a notice to bank. They'll simply say, you are supposed to follow PSL of this much, but you have not followed it. Why action should not be taken against you? Or RBI governor in a meeting will basically point out a bank and warn them. Right? RBI governor will say, these banks have been found to be violating certain guidelines. They better follow these guidelines. Now tell me, what is RBI trying to do with all of this? RBI is trying to persuade, make the banks follow the guidelines. That is called as moral suasion. And if these banks do not listen to RBI, they do not follow all the guidelines set up by RBI, what is the option left with RBI? RBI will penalize them. RBI will simply start penalizing these banks. For example, these banks will go to RBI, they want to borrow from RBI. RBI says, sorry, I will charge a higher rate of interest to you. RBI might simply say, I will impose a penalty of 2 crore rupees. Pay the penalty of 2 crore rupees. So there are various ways through which RBI will take a direct action on those banks, right, who will not follow the principles, or let's say the policies of Reserve Bank of India. So these are the various instruments under the credit control. If there is any issue, please do let me know. Otherwise, we can take a break now. Any issue? Now, please understand this. Some of you keep on telling me during the live class, sir, you are not audible. Sir, you are not visible. My dear, if it is happening to most of you, I generally stop the class and refresh from my side. If it happens from your side, okay, imagine you have written, sir, no audio. I've looked at it and I've seen my tab from my side, audio is going correctly. What you do is hit refresh. Simple. Hit refresh. Automatically you'll get audio. Okay. Any questions? Under PSL, should we know the percentage of A and BC for all 8 sectors? No. For all 8 of the sectors, not required. That's very, very complicated, not required. Net bank credit is same as NDTL. How? You tell me. You tell me. Do you think the total loans issued are equivalent to deposits collected? How? What is your argument? Because it is not. I know that. You tell me. Direct action, basically, it is a policy wherein RBI will impose penalties. Simple. RBI will impose penalties on the banks which will not follow the guidelines of Reserve Bank of India. Right? RBI has various guidelines. If you do not follow them, RBI will impose penalties on you. That's it. That is right, direct action. Any other questions? Any other questions? No questions? Arey Baba, audio feature is also I've made live. If you want to ask questions, if you have any kind of doubt, please do let me know. Sir, what does RBI do? Very interesting question. What does RBI do? My dear, we are discussing what does RBI do for the last 2 hours. Right? You tell me what doesn't RBI do in the context of banking sector. Okay. In liquidity in banking sector, RBI can change repo rate, reverse repo rate, ESTF. Automatically, the amount of money that is there with the banking sector will change. That is basically RBI is a liquidity policy. Last slide, repeat. What point in the slide? You want me to repeat completely the whole slide? How? We spent around 20 minutes to understand what is PSL and what is regulation of consumer credit. Specifically, what is the point? You tell me. Only then I can repeat it. If you simply say repeat everything, how it is rational? You tell me. There should be rationality. Any other questions? Is this qualitative similar to CES? What CES? What CES? Are you talking about central government CES? How? How it should be similar? In what angle are you looking? In what context are you looking? Please let me know. Net bank credit means total loans given by the bank? Yes. Yes, total loans given by the bank. Liquidity trap hinders money supply or not? Of course, yes. But what is liquidity trap? You should be very clear with that. We have not discussed liquidity trap. Maybe when I'm discussing fiscal policy, I'll tell you what is liquidity trap. Okay, in this context, I want you to read this article. Either now, that is during the break, or tomorrow, entirely left to you. But please read this article. Very much related to what we have discussed, right, in the last couple of minutes. This is the article I'm talking about. Court ruling on education loans leaves banks in a bind. Very interesting article. right? Suddenly UPSC can ask you about these kind of loans. Please be very, very careful. Okay, please be very careful. Done. Okay, let's take a break then. Let's take a break. Okay, so we'll restart again at 5:10. Sorry, 6:10. It's already 5:45. 6:10. We'll restart at 6:10. Take a break. We'll restart at 6:10 then.